Hello. Today is Monday, April 1st, 2024. I'm Jason Shapiro with Crowded Market Report. This is my look at the markets closed today. So, it was interesting. We had a number come out today that was, this is a number that was not only strong, but strong in the effect of the inflation numbers too. And it strikes me that that's really the only bearish thing that's out there anymore, because Goldilocks numbers, where we see strong growth without much inflation, it would appear to be very bullish. Even slightly less growthy numbers can be construed as bullish, because that gives the room Fed to cut rates and all that. But this number, there was nothing bullish because it was way too inflationary. And that's the one bearish thing that can happen out here. From a consensus point of view, you get more inflationary numbers. Now the Fed doesn't have the room to cut rates, and that can be troublesome. And that's kind of what we had happen today, because bonds, and it was interesting because the bonds were down going into the number. The number didn't happen until here, right? And bonds had been getting crushed right into it for what didn't seem like any reason. Number came out, okay, bearish bonds got crushed. And bonds pretty much closed on the lows. So what does that mean? Well, interest rates are going up. How are stocks going to react to that is the most important thing. And truthfully, while the Dow was down quite a bit, almost 300 points, the S&Ps were down about 14 points. It doesn't strike me as a killer. The Nasdaq was actually up. Now, I don't really think that small moves in interest rates affect companies that are growing at the rate that some of these Nasdaq companies are growing at. But even the S&P, really not down that much in the face of this sort of only thing that can happen, bearish number. So I don't know. I'm still of the opinion interest rates are too low. I'm still of the opinion interest rates are going to go much higher, and eventually that's going to be bearish. This hasn't given me enough juice to get short that yet. We have to keep in mind that had I said to you in the beginning of the year that people were discounting in 6 interest rate cuts, and by April 1st they'd be discounting in more like 2 or 3, I would have been 100% right about that. But if I had implied that was bearish to the stock market, I would have been 100% wrong, because in the meantime, stocks have gone up, 10% on the year on the S&P, and that while the TLT has gone down on the year. TLT being the ETF that measures sort of broad bonds. The TLT is now down, almost 6% on the year. So if I told you on January 1st, TLT was going to be down 6% on the year, and that expectations were going to go from 6 or 8 cuts to 3, you probably would have made the argument the stock market was going to go down, and it didn't. So, and today it did a little bit, but again, 14 points on the S&P on a day when the long bond is down 2 full points. It's not that convincing to me as of yet. As far as the other assets go, okay, so rates went up a lot, so the dollar went up a lot. Makes sense. But what was interesting, clearly, was the dollar went up a lot, rates went up a lot. And yet gold still ripped, right? Gold's up $26 on the day, granted off its highs, but up $26. Didn't give back very much, even after rates went up and even after the dollar went up. So gold is clearly still in a bull market, And if we define a bull market, I haven't defined it like this, but others have, as one that goes up on positive news and does relatively well on negative news. Gold is certainly in a bull market, and for that matter, so are stocks. So that's kind of my thought on the day here. Much more inflationary numbers. Bonds did what they should do. Dollar did what they should do. Gold is a surprise, and the stock market, while down, was actually, I would think, sort of stronger than one would have had expected had you been given these numbers and given this information about bonds going in. So that's my thought. Always happy to hear questions and comments. And please check us out on crowdedmarketreport.com. Thank you.